Hello and welcome back to the Geordie Pig Investor channel. Today I'm going to go through a US stock analysis of SBUX Corporation. Is the stock a buy right now, as it's been having some turmoil as of late? What is SBUX Corporation? Ticker symbol SBUX. Well, SBUX Corporation, if you didn't know already, specializes in coffee. It's a company that has over 34,000 stores worldwide and it operates in three main segments. Segments are North America, internationally, and in the Caribbean. That's going to include countries such as the United States, Canada, China, Japan, all over Europe, and then into the likes of Jamaica, Barbados, Dominican Republic. Some key stats to do with SBUX is that it's based in the United States. It's actually based in Washington, and it is part of the restaurant industry. It has a market cap of over 103 billion, and it was formed back in 1992. Has an incredible amount of employees at over 380,000 and has had a dividend growth streak for over 13 years now. Has a really healthy 5-year dividend growth rate of over 8.8% and dividend yield of 2.5%. Its 1-year performance chart shows that it's actually down 7.55% and is now sitting around about the $91 mark. What we're going to go through today is if I believe it is a buy, a hold or a sell, and go through some key statistics to determine that. First off, I'm going to go through what free cash flow is, why we need to go through that, and then also show you what SBUX free cash flow is. So free cash flow is the money a company has left over after it pays for all of its expenses and any investment it needs to make to keep the company running smoothly. Usually I like to think of it as a personal budget at home. Once you've paid for all your necessities, such as your mortgage, your food bills, your car, your electric, your emergency fund, then whatever money you have left over is what you're free to spend or save however you like. It's really important to understand because free cash flow is going to have a massive impact on the direction that the company will be heading. It's a good indicator for how healthy a company is and its potential to grow, because if it's got a good healthy free cash flow, it can potentially pay dividends, it can reduce its debt, and it can help grow the business overall. If a company has more free cash flow, then it is a lot more flexible, so they can make a lot more big moves within the company without having to try and get external investments, and they can tackle their own projects. On top of this, if a company has good free cash flow, they can reward the shareholders, like I just said before, by giving back dividends, or they can actually do share buybacks. Share buybacks usually lead to an increase in value of the remaining shares because what they're essentially doing is buying those shares off the market, so then that means there's less shares for everyone else to buy, which is driving the price up. So you want to see growth to free cash flow to see a company becoming healthy. Now we're going to have a little look into SBUX's free cash flow, and I'm going to show you this graph here. On the left hand side, it's showing you the free cash flow from 2014 right the way through to 2024, and you can see how much it progressed from 2014 being in the negative all the way up to just before 2020 and when COVID hit, and it was spiked right up. And they had a really good year before COVID. Then unfortunately since COVID they dipped back down and had a bit of a tougher year. It was an extremely tough year in 2020 because not only did COVID hit, but they actually also had a lot of store closures. They had increased costs for products worldwide, so it was costing them more to actually bring products in. And then they actually invested heavily in digital capabilities. So that was actually more going to be a short-term loss like you can see in 2020, but over the long term, 10, 15 years, which is what I'm more bothered about anyways, it's going to give them good gain in the long terms. So you can see that the cash flow has started to slowly increase since then. What you can see if the free cash flow is pretty healthy at 57%. So that's their payout ratio, which means they're only paying out 57% of their free cash flow every year, and they have 43% remaining, which means if they were to bump their dividends up, they would still have plenty of money left over, and they're not pushing on that higher 80 to 90% free cash flow, which would be of a concern to myself. So that's what I always like to see in a business, that they've got a payout ratio of under about 70%, usually on the healthier side. And you can see, they have, like I say, had a couple of tough years, but they sort of recouped in 2021, progressed up into 2022, dipped a little bit in 2023, and then they're getting back on that progression scale. So hopefully it's going to keep going back up. And personally, I see it as more of a long-term play anyways, and I do believe SBUX has a very, very good, bright, long-term future. The next model we're going to look into is going to be the discounted cash flow valuation. And I'm just going to briefly go through what that is. So it is also known in short as the DCF model. It is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. So the DCF valuation process calculates the present value of a company forecasted cash flow based on a selected number of operating models. The DCF valuation is one of two methods that I'm going to use to value a stock. By having more than just one method, that's going to help us give a true valuation and more of an accurate valuation of the company. On top of these two methods, there's actually going to be a third method that I'm going to go through with you today, and you'll hear about that in a bit. Another way to be certain of my valuations, I actually have multiple valuations. So I don't just plug in numbers for one DCF model and use those. What I like to do is make a best case, an average case, and a worst case scenario, and then I can decide which one I'm going to use and base my prices off. Usually I'll go with more the average case, but I like to see, worst case and best cases as well, so that I'm prepared for if I am to buy into a stock, I know what could potentially happen. SBUX' discounted cash flow valuation. So let's actually go through it now. Reminder, SBUX' price is currently $91. Now, by plugging in the numbers of a discounted rate of 8.35% with a terminal growth of negative 2.7%, you can see that they are valued at just under $38, which would put them in an overvaluation of 58%. Second, I've decided to put in an 8% discounted rate with a 0% terminal growth, which means SBUX would be valued at just under $57, which is an overvaluation of 37%. And finally, best case scenario is if they were to have a growth of 2.7% with a discounted rate of 7.55, they would be undervalued by 10% as they would be worth just over $101. So you can see from these models here, potentially looks a little bit concerning. You might think that's way under what it's valued right now, but we've got a couple of the models to go through, and then we're going to be able to get the average prices from those, and they'll sort of help you understand that this isn't the be-all and end-all. Also highlights why it's so important to have more than one valuation method. The next one we're going to go through is the relative valuation. Relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics include lots and lots of different metrics such as P ratios, EV to revenue, EV to EBITDA, and so on. So you can use different ones that you want depending on the relative valuation that you want to put in. I personally like to use mainly these three, but you can use others as well. So this is going to be the second method that we're going to combine with the DCF valuation. It's actually going to give us something called the intrinsic value. The intrinsic value of a stock has been used for many, many years to calculate different prices for stocks and for different investors to buy at. A quote that I love from Warren Buffett is he's a huge fan of the intrinsic value, and as he says, price is what you pay, but value is what you get. Just highlighting again that there's no good buying a very, very good stock if it is overpriced, because you're just going to end up losing money. You want to be buying a very good stock, but at that very, very good price as well. Here's a little example of a relative valuation table. So moving on to SBUX' relative valuation, the reason you're all here and wanting to see. Like I said before, little reminder, SBUX' price is $91. We're going to see in the worst case scenario, we have a massive $119 on the relative valuation, which is an undervaluation of 24%. On the average case scenario, we had a valuation of $130, which is an undervaluation of 30%. And then on the best case scenario, we had an undervaluation of 35%, which led us to a $140 valuation of SBUX. So these are a little bit more promising. And then what I'm going to do now is give that combination between the two and create the intrinsic value. So the three intrinsic values we got was worst case scenario at $78, the average case scenario being $94, and the best case scenario being at $120. Then what I like to do to back up the valuations that we have already now got is look into the Wall Street estimates. If you're unsure what the Wall Street estimates are, they're an average estimate of a public company's quarterly earnings and revenue that leads to a valuation of the company. The numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation for them. So for companies such as SBUX, because they're such a big company, they're going to have multiple analysts going through the company every single day of the week, every single month, checking through all the balance sheets, seeing how the company's progressing, what sort of areas they're potentially investing into, how they're paying things out, all that sort of thing. They're going to go through all of it, and then they'll come up with a valuation based on this. They're also sometimes known as earning estimates or earning expectations. So bigger brokerages will use these estimations off of the Wall Street estimations so when a company's about to release its financial reports, they'll actually use the Wall Street estimations as their gauge. So if a company is to beat the Wall Street estimations, then that means it's likely that the company's going to go up in value. And if it doesn't quite hit the Wall Street estimations, then that company may dip down in value. I like to use as my third estimation after the DCF and relative valuations because it makes me feel a lot more confident when buying a stock. This is just going to further solidify my initial thoughts and the information I'm already gathering, if these estimations kind of match up with the prices that I've already been getting. I would never use these on their own because, like I say, they are just estimations at the end of the day, so take that in mind as well. And with me being a long-term investor, I look to hold my stocks for over 10 years. So I don't look to sell very often, but if I need to, I would potentially reduce my allocation of stock if I feel it's extremely overpriced and I may want to trim down a position. Or the only other time I would potentially sell is if I'm not happy with the total position and the direction that company is going in. So if I believe a company is potentially cutting down the dividends, or their free cash flow ratios are getting really high and an uncomfortable rate where I believe that the company's heading in the wrong direction, then I may potentially buy out of them. But when I'm doing these analysis videos, these types of companies I'm looking to hold for a long time. So I want to be analysing and being really serious about, if I'm going to buy a position in this stock, I'm going to be buying this for over 10 years and not looking to sell anytime soon. Again, as you're all here for, let's actually go through the 3 Wall Street estimations for Starbucks. So they've estimated a worst case scenario at $96, an average case scenario at $109, and a best case scenario all the way up at $133. So these 3 numbers obviously all above the current price of $91. And from this, it means I can now get my average of all 3 combined. Worst case at $84, average case at $99, and the best case was $124. So by using a 10% margin of safety on the worst case, it means I'll be looking to buy at about $75. With a 20% margin of safety, $67. The average case at being $99, if I use a 10% margin of safety, my buy price would be about $89. And with a 20% margin of safety, my buy price would be about $79. And then on the best case, you'd be looking with a 10% margin of safety to buy at $111. And with a 20% margin of safety, buying around about that $99 mark. I will usually use the average case scenario. So going off the average case scenario here, it's at $99. And then I like to do either anything between that 10 and 20% margin. But with Starbucks being a bit more of a premium company now, I would usually favour towards the 10% margin of safety mark. So my overall conclusion for this, is Starbucks a buy right now? Well, like I just said, I believe the company is showing some promising signs. And although it's having some short-term issues, especially with a lot of stores closing down in the Middle East due to some conflict over there at the minute that I'll not go into any further, but that has actually had a big impact on them. And there's been also protests from some of the employees out there, so that, like I say, they've closed down a few stores, but that is definitely more of a short-term issue. And like I said before, I am way more bothered about the long term with all my stocks. I believe Starbucks is going to have exceptional long-term dividend growth with real solid fundamentals in place. However, right now, sitting at $91, it's just slightly above my buy range. Like I say, I'm happy to buy at that average price with a 10% margin of safety, which would mean I'm looking to add around about that $89 mark. So it's currently sitting at 91. If it was to creep below the 90 and get into those 89 figures, that would be likely where I'm then going to start adding again. But like I say, it's still sitting at a really attractive price. So I wouldn't blame you if you did want to add at $91. So I hope you've enjoyed the video today, guys. Please let me know of any other stocks you want me to do a breakdown on. This was my first American stock that I've done a breakdown video on. If you want to see more US ones, because I know they can be a bit more popular, let me know. But I do really enjoy going through the UK stocks as well. So my plan is to sort of put content out for both of them. And I hope you do enjoy all of it. So if you did enjoy, please like and subscribe. And this is the Geordie Pig Investor, over and out.